All right, everybody. Well, thanks for joining in. For those of you live, welcome. For those of you who are joining virtually, it's good to see everybody. So our topic today is really going to be talking about an introduction to franchising. What I want to do is spend some time this afternoon to give everybody an overview of where the opportunities lie in franchising and just chat a little bit and answer your questions as they come up. So with that being said, let me just spend a little bit of time to give a little bit more background about how I approach this franchising discussion. And then the way I thought we would handle this today is to do this through some FAQs. So I've come up with what I think are 10 pretty frequently asked questions. And what I'd like to do is just spend some time answering those questions and handling any questions that come up from you that are supplements to those. All right. So as Allison said, my background is as a CPA. I've been a business owner in a multitude of different businesses for almost 25 years. Many of those businesses at the beginning of my ownership track were actually non-franchise related. And over the last, well, let's say 10 years, 12 years, I have moved increasingly into the franchise world because I've seen that as a really clear path for me to be able to achieve some growth and scale. I've been on the faculty here at Carnegie Mellon. I'm actually in year 15 now, and I've taught a variety of different classes, including an entrepreneurship through franchising class that I teach today. All right. So I want to talk today about franchising because I really want to expose all of you to what I think is a very smooth transition path of how you can use franchise ownership to migrate from being an employee to being a business owner in a very smooth way. Often that's a somewhat rough transition with a lot of rocky pieces. And I think that one of the appeals to me of franchising is that there are actually paths in there that allow you to do both. You can keep your income, keep the security, keep the job that you have, while also dipping your toe in the business ownership world. And then once you get comfortable there, you're going to realize you don't want to go back the other way. You're going to just jump in the pool. And then all the fun starts. All right. So I want to talk today about how that can look and how you can leverage franchising to make that pivot into business ownership. All right. All right. So let's talk about some of the FAQs. And as we go through these, if you have follow-up questions, I encourage you to ask those. The purpose of me being here today is to give you the information that you need. So if you want more detailed information on any of these, I encourage you to chime up and ask questions. For those of you who are online, you can either unmute yourself to ask your question, or you can also chat it in and Allison will cue me with those so that I can answer them as they come up. All right. So question number one that I face all the time is, all right, so you're talking about franchising. Everybody wants to immediately migrate that conversation to food-related items. So I want to talk a little bit about this. Yes, there are a lot of food-related franchises, and they're very successful. But what I want to open your eyes to is that there are also a multitude of franchise whole segments that don't have anything to do with edibles. All right, let's just take some real quick examples, right? The automotive industry, let's just talk about that for a minute. The automotive industry, not only the aftermarket service side, right? One of my favorite companies is Jiffy Lube, right? I spend a lot of money at Jiffy Lube. So that segment of Meineke and Amco and Maaco and all of those aftermarket service companies, that is certainly a big piece of the franchising world. But also I want you to think in the franchising world in automotive of the dealerships themselves. The new car dealerships are also very large, expensive, successful franchises. So Ford and all of the General Motors brands and Toyota, Honda, those are all franchise businesses in the United States. All right. Business services. May not be one that naturally kind of flows off your tongue as being something that is franchising related. With a business partner, we own a great example of this. We own an outsourced bookkeeping and accounting business called Supporting Strategies. That's a business services company that is structured as a franchise. All right. Healthcare. All right. So healthcare, many people think about their doctor's office or a hospital. All right. Not usually franchised. However, There's whole other wings of the franchise world that have permeated into healthcare. So all of the home services related senior care businesses all tend to revolve around a franchise model. Miracle Ear, where my grandmother goes to get her hearing aids tuned up, franchise. So there's a lot of really successful franchises, even within the healthcare space. Once again, may not have been one you thought of immediately coming into today. I want to open your eyes to other segments that you may not have considered. And then the last one that I'll want to just open your eyes to is what I'll call personal care or beauty, right? This has been over the last, 5 or 7 years, one of the most rapid growing segments of the franchise world. So this could be businesses such as Massage Envy or European Wax Center or Decalash that are all beauty and personal care related businesses. This is an industry segment that as a whole is really blossoming right now. And I think that the franchise businesses in that space are really leading the way. So my point being, we initially say franchise, and many of you, your minds probably went to driving down Main Street and you see one food establishment after another. What I want you to now start doing is looking a little bit further back on the road and seeing all of the other franchise businesses that are there as well. Okay. All right. Question 2. This is the acceptable greed question, which is, okay, in a franchise, how much money am I going to make? All right. So here's my answer to this. This really is 2 separate questions, both of which are important, but I want to answer each of them in turn. The first question is, what's the total income opportunity? When it peaks out, how much money can I make in this business? But the second and equally important question, how quickly can I earn that income? All right, so let's talk about each of these. Okay, here's my answer to this. In a franchise business, can you earn $50,000 a year? 100% yes. Now, to be crystal clear, can you do that in every franchise? No. There are a lot of franchise brands that admittedly aren't very good. It's going to be very difficult to eke out a profit. Okay. However, in most of the what I would call good franchise brands, can you make $50,000 a year? Absolutely yes. Can you get to earning a 6-figure income from those businesses? Yes. There's a caveat. There's a but that comes along with that I'll get to in a minute. Are there franchises where you can be earning $250,000 or more in a year? The answer to that is absolutely 100% yes. Okay. Now, as you move down this path of wanting to go from 50 to 100 to $250,000 of income, how do you do that? All right. What I will tell you is there's 2 elements to that. The first is time. Okay. As the business grows and matures and scales, it's going to provide more income opportunity to you. Okay. That's obvious. That's no different than any other business. All right. The second is what I really think is one of the hidden secrets of franchising, which is multi-unit ownership. So if we go back a couple of slides, right? If we talk about a lot of these businesses, many of these businesses are ones that are built on having a brick and mortar location. And each one of those building blocks is going to have some income opportunity attached to it. What a lot of very successful franchise owners do over time is they build a box, build it up, it becomes profitable. What do they do next? They build a second box, build it up, make it successful. What do they do next? You got it. Third box. That ability to become a multi-unit owner in a franchise system is absolutely one of the paramount elements of success in the franchise world. Franchise businesses are set up to facilitate a small number of owners becoming multi-unit owners and therefore increasingly successful. That is how franchise models are built. They're built to facilitate that kind of ownership. All right. So one of the things I want to encourage you to do as you think about franchising, don't think about it as I own this one little building block and I need to just optimize this one. What I want you to think about is over time, own 3 or 5 or 8 or 10 of them. And even if they're only 90% efficient, if you own 5 or 8 or 10 of them, That's a pretty big pile of success. All right. So the answer on income is absolutely, the opportunity is there. Now, speed to cash flow is the related issue. All right. So what I want to do is tell you, if you want to move to cash flow faster, there are 3 factors that I think you should consider. First, if you step into a model where you are going to be the day-to-day operator, you will reach positive cash flow faster. Because obviously you don't have to dedicate financial resources to paying a manager to do it. You can do it yourself. Second piece, service-based businesses are going to become profitable faster than retail brick and mortar based businesses. Why? 2 reasons. One, it's going to take you less capital up front to start the business. So therefore you have less capital that you have to recoup to pay off debt service and everything else. But second, has less overhead every month to pay. You don't have rent and utilities and expensive square footage that you need to fund. All right. So I want to encourage you to think about owner-operator businesses and service businesses. The third piece of this, businesses where you're selling directly to an end consumer, will become profitable faster than a B2B model. Simply because a B2B sales cycle involves a longer process with more decision makers than a typical B2C servicing model. All right. So if we combine all of these together, if you found a business that was owner-operator based in a services industry servicing a B2C marketplace, your likelihood of becoming profitable faster soars compared to the complete other extreme, which would be something that's a manager-run business located in a retail box where you're servicing a B2B customer. All right. All right. Now let's talk about the flip side of the finance equation. We just talked about the income opportunity. Now I want to spend some time to talk about the investment requirements. All right. So when somebody asks me, how much does it cost to invest in a franchise? My answer is, it depends. All right. That is the same as me asking you, how much does it cost to buy a house? It depends. So what I will tell you is there are very successful franchise brands where your required investment to start the business is $50,000. Likewise, there are very successful franchises that require a $3 million investment. All right. So anywhere on that spectrum, you're going to find a range of success and failure at each different investment criteria level. All right. There is not a correlation to spend more and have a higher degree of success. That correlation doesn't exist. At low investment levels, there's both. At high investment levels, there are both. So don't necessarily think that you need to spend more money to achieve success. You don't. My personal bias is to invest in very low investment, low CapEx businesses, and they have very high income opportunity and a high likelihood of success if we act on the plan properly. So there's not a correlation here that you need to worry about. I will tell you that the vast majority of franchise businesses are going to fit in this investment range of $100,000 to $250,000. That's the working range that I want you to think about. All right. Now, just a note, that investment does include all of the business related investments. It does not include your personal living expenses. So if you're in a position where you don't have a partner who has an income that you can lean on, or has a health insurance plan that you can hop onto, there's going to be incremental investment that you need to block out to pay your personal bills while you're ramping the business. All right. All right. Now, let's talk about financing next. Just as in the last slide, we chatted a little bit about the investment level in a franchise being compared to buying a house. There's a wide range and there's a lot of different options in there. Financing, I want you to draw that exact same parallel. All right. Most franchise investments are structured as a down payment and a loan together to fund the business. Okay. The down payment in most franchise related businesses typically is going to run about 30% of the total investment. So as an example, let's assume that you were going to open a small brick and mortar retail beauty business. And your investment was going to be $300,000 for that store. Your expected contribution to that would be about $90,000 of cash and a business loan to make up the additional $210,000. Okay. Banks are very comfortable lending into franchise related businesses because they can go back and study, just as you can when you're doing your investigation, the prior track record of success of that franchise. It builds their confidence that they're going to be making a loan to you that's going to be repaid. All right. So the confidence level here in terms of borrowing is very high, and you can get a pretty decent leverage ratio. All right. Let's talk about where to come up with this 30%. All right. Because it does not, I want to be crystal clear, need to come from your pocket. There's a lot of pockets this can come from. All right. First, let's assume that you've been saving money for an investment. You can certainly use that to fund your franchise. All right. That's the easiest option. Low barrier, low time commitment. You just write a check and you fund it. Now, second option, you can utilize a 401k rollover. All right. So let me be crystal clear. I'm going to put my CPA hat on for a minute. Okay. In this world, you can take qualified retirement account money that is sitting in an IRA or sitting in a 401k, can roll it over. You're not taking a distribution. You're rolling it to another qualified 401k account. And that account is then buying stock in your business. That is not a taxable transaction. There's no penalty for early withdrawal. Interestingly, there's also no interest on that because you're not borrowing. Your 401k account is making an investment. All right. So the advantage of that, it creates for many investors an opportunity to be able to harness a chunk of investment capital they didn't know they could use. All right. Create some interesting opportunities. All right. The third option, find a partner. What I will tell you is, regardless of what part of entrepreneurship you might be pursuing, whether it's franchise ownership, a business acquisition, a startup, I don't care. If you have a good idea, there is plenty of capital to support your business. And if you have a bad idea, you will never find any smart capital. So I think it's a good idea for you to be able to go out and pitch your idea to investors, because it's actually going to be a reinforcement of your decision. If you can find investors to come along for the ride with you, it's going to be a reinforcement for you that it's a good ride to be on. That those smart investors looked at it, they vetted you, they vetted the idea, and they said, yes, that should actually give you reassurance that you found a good opportunity. Okay? On the flip side, if they don't come along for the ride, ask them why. And what they're going to do is they're going to point out to you the flaws in the business that you maybe don't want to hear about, but you need to face them. Okay? So finding a partner is a very popular way to fill in that equity gap. All right. Now, the loans, as I said earlier, banks love franchises because the proven nature, the track record of success, the banks see that as a risk mitigator, and they see it as a safer loan to make. All right. Other options in the lending area, right? You can go out if you've got a house that you own that over time, as prices have appreciated and you've paid down your mortgage, that home equity gets bigger and bigger and bigger and bigger, right? You can borrow against that. Set up a home equity line of credit, draw down on that. It's a lot simpler than an SBA loan. It's a lower interest rate than an SBA loan, and it's still tax deductible. So that's also a viable lending alternative for yourself. And the final one is, if you have an investment portfolio, non-retirement investment portfolio, set up a margin loan against that and borrow against your investment portfolio. It's the same thing as doing a home equity loan. It's just a different collateral piece that you're borrowing against. Okay. Once again, a lot of options on both the equity side and the loan side. Okay. Any questions from anybody so far about either the income or the investment side of the franchise equation?
seems like some of these financing options are way more risky than others. Like taking out margin and then, the market tanking or something is a real possibility. So like maybe there are better ways.
Yeah, I mean, I think that anytime you're taking on debt in some way, shape, or form, there's risk attached to that. And you need to balance where that risk falls in for your personal profile. Yes, that's absolutely correct. So you've got to figure out, am I borrowing 100% of my capacity, or am I borrowing 50? And the market can have a pullback and I'm still okay. You have to evaluate that. Absolutely. Question?
You mentioned service franchise. Can you give an example of that and why is it?
Okay, good question. So service related franchises. So the easiest kind of grouping that I could give you for that would be anything that's home services related. Exterminators, painters, lawn care, tree trimming, anything like that. One of the most successful franchises in the United States is Lawn Doctor. They come to your house and they're not cutting the grass, they're fertilizing and they're aerating and they're doing bug treatments, right? Extraordinary 55 years of success, 600 locations across the country, very, very successful business. Now, why is that profitable more rapidly than a retail business? Because you have less overhead to cover every month. You run a Lawn Doctor out of your living room with a van that you park in your driveway. There's no rent, there's no utility cost. It reduces the burden of what you have to pay before you can pay yourself every month. That's why. Go ahead.
For that Lawn Doctor, example, I understand it as like I am that person who's working as kind of Uber driver.
Okay, good question. Okay, so let's talk about that. Maybe you can be that person, but you don't need to be that person. So you could make a decision to say, on day one, I'm going to own the business, I'm going to drive the marketing, but I'm going to have somebody else that I'm going to hire be the technician. You can do that from day one. The alternative is you could wear both hats. You say, in the morning, I'm doing marketing, I'm doing paperwork, and then in the afternoon, I'm going to go out and do all the treatments. You can do it either way. Depends on how actively engaged you want to be and how much of a time commitment you want to make to the business. Both can be successful. Go ahead.
Sorry.
No, that's okay. I'm here to answer questions. You ask as many as you have.
Because then my mind is going to Uber. So for example, Uber is not doing a platform, they are doing franchising business, and then they are franchising their service to different regions, different like suppliers or distributors, as you would call it. Okay. And that would really change their business models. However, I think Uber is more successful as proven to be a tech or software platform. And then for that Lawn Doctor business, for example, will they be more successful if they use that kind of platform as a revenue models or business models as compared to franchisee for service?
So I see some parallels there. I see some very big differences, right? The franchise model has exclusivity to the region that Uber will never have, right? You've got Uber drivers literally doing this every day and crossing over each other with no exclusivity other than that ride that they're on, right? Lawn Doctor is completely different. You're going to buy a region, I'm going to buy a region, and we're going to have a line in the middle where you stay over there and I stay over here. So it's a very different way of looking at it because the system is set up to have me optimize, invest in, build a team, build a marketing plan, develop relationships here in a way that is very personal to me. The Uber model being very distributed is the complete opposite of that, which is each one of those experiences is one unique experience that will never recur. And so I just think it's a very different way of structuring the business.
Or just one more blow.
Please.
So from the business perspective, so for example, if I'm a business owner of Lawn Doctor in general,
yes,
instead of making regional franchisee, which I assume that one person or that one franchisee will have very limited capacity for marketing or for personnel. Why would actually use franchising models as compared to Uber platforms?
Okay, good question. So I think that the advantage of doing it through a franchise model, right, is you have the systems that you have with Uber, right? You have the brand name that you have with Uber, but you also have complete discretion to drive your local business the way you want to, that Uber doesn't have, right? The driver has zero discretion about what to do other than use the system and put the placard in their window and then wait. The lawn doctor owners have a different level of discretion in that last piece, which is how do I build a recurring business and build something of value to me in this marketplace? Yeah, it's some similarities, but I think more differences than similarities.
When you are going out and getting a loan, is that affected at all by the type or the source of the equity that you are using to bring it down payment? Like, are they looking at certain, you know, if I put all cash in, is that less, is that more attractive or less attractive than if I go out and like take out, you know, give a partnership or
Okay, good question. So the bank will look more favorably on the loan if you have more capacity than you are using. Okay, so where that plays in. If you could fund it all by yourself, but that leaves you high and dry with no remaining reserves, the bank's going to see that as far riskier than if you bring in a partner who's contributing a very small portion of their capacity, has more backup available. The bank's going to look at that and breathe a big sigh of relief. So the answer is yes. Even if you can check the box and say, yes, I put 30% in, the next box is there more available, right, as a backup plan? And the bank is going to look at that. So I think the way that you structure the equity does have some bearing on how the bank will see the loan. Yes. Okay. Any questions from online, Allison? Okay, good. All right. All right. This, I think, to me, is the most important question to ask yourself. What am I going to do every day? All right. So let's talk about this. There are three very distinct ownership models in franchising, and they have some overlap, but I want you to understand that over time, they look very different from one another. So we're going to talk about each of these in turn. We're going to talk about owner operators. Those are folks that on a day-to-day basis, they dig in and they're running the business. Executive owners are active in the business every day, but they're active by leading a team of people. And then let's talk about semi-absentee owners, which are, as the name would tell you, somewhat passive to the business and only involved on a part-time basis. Okay. All right. Owner operators. So an owner operator, let me give you an example. Let's assume for a minute that you were going to buy a budget blinds franchise. Okay. Budget blinds provides window coverings primarily in people's houses. You can do offices and retail parks, but most of the time it's in people's houses. The owner of a budget blinds franchise is the person who is coming out to your house to do a design consultation with you. They are the one coming out in the van, walking through your house, measuring the windows, showing you options, writing the order. They go back to their house, they order the product. It comes in, they come to your house and install the window coverings. That is an owner operator. They are hip deep in the business every single day. They're directly engaging the customers. They are directly engaging other employees in the business. Okay. In this model, there is some element where you really do need to love the business. Because if you don't love the business, you're not going to want to be hip deep in it every day. Okay. Now, These businesses, as we talked a little bit about before, these are typically service-based businesses, and these are typically these are owner-operated. These will be profitable very quickly. Okay. Now, the next model is what we're going to call an executive-owned model. So in this business, you are still active in the business every day. You're in there, you're running it. But instead of being the direct conduit to the employees and the direct conduit to the customers, now you've built a team of people that are doing all of those ground level interactions. It's not you anymore. Your role in this business is now to be a financial leader, to be strategic, to be a team builder. Okay. So example of this would be a ServPro. All right. So ServPro is a disaster restoration franchise. You have I hope this never happened to you. It happened to us once. A sewer backup in your house, not pleasant. Okay. A fire, a broken water pipe, and you've got a wreck in your house. ServPro comes to your house and they tear out the carpeting, they tear out the drywall, they put in the air movers, they put in the dehumidifiers. The owner of ServPro is not the one in your basement squeegeeing water, I promise you. The owner of ServPro is the person who developed the relationship with the plumber and the fire department and everybody else to call them and say, hey, I'm on my way to Main Street to this house. You might want to show up because we've got a fire and they need help. Okay. That's what the owner does. They develop marketing relationships. They manage the financials. They make sure that the team is built to respond when the phone rings. Okay. Now, semi-absentee businesses. This is the area that I think lends itself very naturally to being a transition point for you career-wise. You start in an employee model, and over time, you can be an employee and a business owner in a semi-absentee model. And then finally, you get to a point where you're just going to be a business owner. You've grown the business, you've matured it, you've grown the income to the point where it can support you. Okay. In these business models, you are only ever the owner. From day one, you hire a manager to run the day-to-day, and you don't step in the business. You're going to interact with that manager on a limited basis, and I'm calling that limited basis 10 to 15 hours a week. And on that limited basis, you're talking to them about team building, marketing effectiveness, financial management, but what you're not doing is managing the employees or interacting with the customers. The manager does that every day. Your role is to be a strategic leader of the business, and that's it. So a great example of this is any hair salon. Sport clips, great clips, supercuts, I don't care which one, right? You can be a semi-absentee owner because you step in, you buy the business, you set it up, you hire a manager. You are underqualified to manage a supercuts because you don't have, I'm guessing, none of you have expertise in hair cutting. Okay, that's great because the less you know, the less likely it is that you're going to try to get sucked into the day-to-day operations. Hire the manager and get out of the way. And when that business gets built up and it's stable and successful, what are you going to do? You're going to go find another one, hire another manager, build a second box. And by the time you get to the third one, guess what? Now you're at a point where this is probably producing a healthy income. And now you're going to say, do I really want to be working a full-time job and doing this? Or do I want to open a third or a fourth location and just do this? That's your transition point. That's how semi-absentee ownership, I think, starts as an and then it just becomes your only option after a period of time. Okay? So 3 different models: owner, operator, executive, semi-absentee. All right. If you own a business, and I don't care what kind of business it is, I don't care if it's a startup, if you acquire a business, if you start a franchise, you need to be responsible for sales and marketing. Like that is my #1 truth of business ownership. If you're not, nobody else will be. All right. So I want to talk about what that looks like in the franchise world. From my perspective, in the franchise world, sales and marketing comes down to one of three things. One, you are the salesperson, okay? So for example, I own a particular franchise called Expense Reduction Analysts. In that business, I am the sales team. I'm the one building the referral partnerships. I'm the one engaging with the customers. And I do that because I enjoy it and I'm good at it. There may be other people that when I say sales, they get terrified. Their palms get sweaty, they get the shakes. Then don't do one of these. There are plenty of other franchises that fit model 2 or 3. Model 2, my sister owns a roofing contracting company. All right. My sister does not like to do sales, but my sister's a very effective leader of people. And so she found a franchise model where she doesn't have to be the salesperson. She has a hired sales team and she is the sales manager, but not the salesperson. Works great for her. Okay. Third option. There are a lot of franchises that are just marketing driven, right? When was the last time you saw a salesperson from Dunkin' Donuts? Never. They are a marketing driven brand. All right. They can have an enormously successful market presence without having to have a direct sales force. Okay. So all three of these options can be effective. What you have to figure out is which of these resonates most with you, and then find businesses that fit that profile. Each franchise tends to fit in one of these three buckets. And there's not really a whole lot of overlap between them. So you just have to figure out which of these is comfortable to you, and maybe it's multiple, and eliminate any business that doesn't fit the buckets that you're comfortable with. All right. All right. This is the hardest question that people ask me with franchising. So what's the best franchise, right? I go to a cocktail party and people kind of lean in and they're like, so what's hot right now? What should I be looking at? This is this question. If I say to you, what's the best restaurant in town? I'm going to get a bunch of different answers. In fact, you probably in the same sentence are going to say this. Oh, but what about this? Oh, I also like it. All right. So this is a really difficult question. The question is best answered by this point. What do you want out of the franchise? All right. So to give you some perspective, in the United States today, there are plus or minus a little bit, there are about 4,500 different franchise brands. Okay. That's a lot of options. Okay. I will tell you that from my experience, a very significant portion of those 4,500 are not very good brands. They don't have good leadership teams. They don't have good available territory options. They're not very financially productive. Okay. But even once we get all of that out of the way, and now we're left with a group of brands that we would look at and say, from a business perspective, okay, these are decent opportunities. You now have to figure out which of those matches you the best. All right. So we talked before about what I consider to be these primary criteria of how to make that decision. The owner's role, owner operator, executive owner, semi-absentee. What sales and marketing role do you want to have? How much capital do you have to invest and how much income do you desire for the business to produce for you? Okay. If we spent an hour-long conversation just focused on answering those 4 questions thoroughly and honestly, without you trying to fake it to yourself, we just got to that, we could probably narrow in to no more than 24 brands out of 4,500 that just match that. All right, that's pretty close. Now, to parse out the differences, now we start looking at some of these secondary criteria, right? Does it have territory available where you want to live? Do you want a lot of employees? Do you want not a lot of employees? Do you want certain types of employees, but not other types of employees? All right. Do you care what industry it's in? Maybe you do, maybe you don't. Do you care about having a new emerging franchise versus having one that's more established, right? These are some of the secondary criteria. They're important, but to me, this is splitting hairs. If you get these 4 on the left-hand side correct, you're going to be pretty happy. And you're going to find brands that you're going to do that investigation and you're going to feel comfortable that those are a good opportunity for you. Okay? This is how you figure out what the right brand is for you. It's not guesswork. It's not picking things off of a board. It's doing a very logical, honest discussion with yourself about what do I really want this business to do for me. Those 4 primary criteria, they will change throughout your working life. When you're 30 years old or 28 years old or 26 years old, you're going to look for something where you're going to say, listen, I'm willing to work really hard, but I don't have a whole lot of money to put into this deal. When you're 50 or 55 years old, you're going to say, I don't want to work that hard, and I do have money available. You're going to look at very different brands at different points in your career. So just realize that this is not a one-size-fits-all for other people, and it's also not one-size-fits-all for you throughout your career. It's going to change. Questions? Okay. Now, yeah, go ahead.
So, do people ever kind of move through the spectrum on either the sales side or the role side? For example,
Yeah.
do they start at being an owner operator and either plan to or realize later that, hey, I just want to be a more absentee or something?
Yes. Yes, that happens. So, for example, my sister, I told you, she owns a roofing contracting company, right? She started that business 8 years ago as an executive owner, deeply involved every single day in the business. Over the last 18 months, she has backed out, put more responsibility onto her leadership team, and she has backed out to now be able to pivot her attention to a second opportunity. So yes, those changes happen gradually and over time, and they're driven by the maturity of that business. So I don't want you to think that on day one, you can force fit a solution that business isn't made for at day one. But at day 6 years, it may look very different. So yes, there could be a migration within a business, or you in your career also migrate to different opportunities. Yes.
Not like planned migration. Or 2 years I want to
Look, all plans are made to break down, right? So yes, you can plan it, and yes, you can try to move directionally there, but it's not going to be linear, right? It's going to be kind of a wavy line, but as long as you're generally moving in that direction, you're going to be okay. Right. All right. Okay, so a couple of other items that I want to mention to you. So if you went online and you started Googling best blank franchise, best food franchise, best auto franchise, best healthcare franchise, okay? You're going to find pages and pages and pages of lists, okay? Most of those are absolutely meaningless to you because those are simply paid advertisements. The companies pay to participate in the best of list, okay? Disregard them, okay? Where I think there is some semblance of organization and reliability, right? First, Entrepreneur Magazine every January publishes the Franchise 500. They tell you very clearly what their ranking criteria are. So you can choose to like it or not like it, but they at least give you, here's our criteria, and here are the top brands based on these criteria. Great. My opinion, Forbes magazine does a bit of a better job. Every summer, they publish a ranking and they stratify it by income as well as different types of industry types. Here are the best and interestingly, the worst franchises based on these criteria. That's a fascinating article because they actually throw brands onto the bus, which I find really interesting. The third, if you start doing a detailed investigation of a brand, should ask that company if they have ever had a franchise business review survey conducted. So FBR, what they do is they do deep dive investigations of brands. And the way that they do it is the franchise company has to volunteer to participate. So they will say to Franchise Business Review, we'd like you to conduct a review. They stroke a check, they pay Franchise Business Review, and then Franchise Business Review shuts the door. The franchisor is over there, and now FBR is interviewing all the franchisees with no input from the franchisor. It is truly independent information. I participated in one of these for a brand that I'm a franchisee of, and the survey that they do is exhaustive. They ask detailed questions. They ask for written kind of narrative responses to a lot of them. And it is really valuable information if you're doing an investigation. Now, not every brand does one of these, but if they do, it's worth reading. It's a mountain of good information. Okay? All right. All right, let's talk about success rates for a minute. All right. This number's a bit outdated, right? But in every FDD in the country, so an FDD is a franchise disclosure document. Every franchise company has one, and every franchise company publishes a new one every year. It has 23 required disclosures. Item 20 in that document is what I call their success chart. All right. And this is a chart that basically says over the last trailing 3 years, here's how many units there were at the beginning of the year. Here's how many we opened. Here's how many closed. Here's how many transferred. Here's how many we reacquired. Here's what the balance was at the end of the year. You can look at that chart, and that is completely objective information that you can use to say, what's the success rate here? Do we have a high closure rate, a low closure rate? Is it growing? Is it shrinking? What's going on in the brand? That is objective information. Okay? I think that's a great way to look at success rates in franchising. All right. If you're going to conduct a franchise investigation, what should that process look like? Right? I think that there are levels of investigation. All right. So, and each one of these breakpoints between foundation and validation, and between validation and confirmation, right? There are distinct breakpoints that I view as red light, green light stop points, right? You're going to conduct what I call foundational calls, right? You're going to talk to a franchise company employee, and they're going to start educating you about, here's an introduction to the brand. Here's how we do marketing. Here's where our target customer is. Here's how we operate the business. Here's what our financial model looks like. Okay. And you're going to gather all of that foundational information. And then there's going to be a stop point where you're going to digest all of that. You're going to think about it, and you're going to figure out, am I interested or not? And if the answer is even marginally no, be done with it. Life's too short, and there are too many opportunities for you to mess around with ones that are marginal. Okay. Let's assume you ask yourself that question and you say, yes, I'm genuinely interested. I like the story here. Okay. Then we move into what I think is really the heart of the investigation, which is validation. Validation is you going out and having an opportunity to now talk to the current franchise owners in that system. You can talk to as many as you want. There's no restrictions on this. And those franchise owners can tell you nothing or everything. All right. But that process to me is the most important element of doing a proper franchise investigation, because this is where you're going to hear all of the real truth from the ground level of what's occurring in that business today from the franchisees who are doing it. Once again, another red light, green light decision. So you gathered foundational information. You said, yes, I'm interested. This validation process is intended as a checkpoint saying, okay, the franchisor told me these 7 key important facts. These are drivers of success or failure. You then validate each of those 7 points when you talk to the franchisees. Talk about ramp up. You talk about support systems. You talk about effectiveness of marketing. You talk about how easy or difficult is it to build a team. All of those questions. And if you have a green light after validation, then you spend time to go meet the executive team from that franchise in person. They get to meet you. You get to meet them. And you have to decide, looking them in the eye, do I want to be business partners with you for the next 10 years? Do I like and respect you? Do I think you're going to provide me with the tools I need to succeed? They're making exactly the same judgment about you. They're looking at you and saying, are you going to follow the plan? Are you going to be a good operator? Are you financially committed? Are you time committed? Do I think you have the skills needed to drive this business well? Okay. That, if you do all three of those steps, that is a successful due diligence process. Okay. Once you finish all that due diligence, I want you to realize that's not, I open the doors tomorrow. Okay. Now we've got a startup phase, right? Now you're going to say, I did my investigation. I'm going to go forward with the business. Now I've got setup. If this is a service-based business, that's probably a month, right? But if it's a retail business, it's 6 or 9 or 12 months just stuck here in this phase, trying to find real estate, build it out, find a contractor, staff up my business, right? This phase can be painfully long for some businesses. And then you get into phase 3, which is I'm operating my business. Now I've got to push the marketing. Now I've got to build a team. Now I've got to execute on the business. All right. So I want you to realize all of that investigation process is just the beginning of a successful path to a franchise. All right. So what I would say to you is, if this is something that's interesting to you, right? I think the keys to this are, as we talked about earlier, you have to self-determine what are the criteria that are important to you. What role do you want to play in the business? How involved do you want to be with the sales and marketing program? How much capital do you want to invest? How much income do you want? Right? Those 4 criteria really are the heart and soul of this process. And then you start digging into brands that look like that. And I think there's a lot of folks who can guide you through this process. Just as when you search for a house, most people do that with a real estate agent as a tag team partner. I think it's helpful in this to do it with people who have experience of guiding the investigation, because they're going to give you some barometer of that's normal, that's not normal, that's acceptable, that isn't acceptable. All right. So that's what I think your next steps look like in the process. All right. All right, let me back up here. I'll leave this up on the screen. Questions? Go ahead.
Is FranChoice kind of like a team-based service or franchise consulting, or
Yeah.
is there like some sort of equity agreement afterwards if they also like the deal, and they be a partner?
Yeah, good question. So you should think of franchise consultants in general, right? FranChoice being one group of consultants, but there's others, right? You should think of that as real estate agents. They're going to guide you to find something that matches the profile that you've described, right? If you hire a real estate agent, you're going to say, listen, I want to live in this neighborhood. I want a house with this many bedrooms. I need a garage or I don't need a garage. I want to be close to a park or close to a bus line, right? You give your criteria. The real estate agent helps you identify options and then screen through them. That's what a consultant does. You don't have to pay your real estate agent because they get paid at the closing by the seller. You don't have to pay your franchise consultant because they get paid at the closing by the seller, the franchisor. So yes, there's a fee, and no, you don't have to pay it. All right. But they do exactly the same function that a real estate agent does. Yep.
There's sometimes I'll see like a certain location that has, let's say it's like a company, for example, right? They'll have that and a fried chicken place within it. Are there other examples of like multiple businesses within the same like area? Are those considered franchises?
You mean co-located?
Yeah.
Yeah. So, I mean, sure, there are some of those. They're often in the same family, though. So, for example, at Squirrel Hill, right? There's a Dunkin' Donuts on the corner, and literally right adjacent to it is a Baskin and Robbins, right? That's the same franchise company that owns both of those brands. It is the same franchisee that owns both of those locations. So they co-locate them because it's mutually beneficial. I'm buying donuts and coffee at 8 in the morning and I'm buying ice cream at 8 at night. And I can take my employees and shift them from one or the other. The same POS system, it's the same everything. So yes, there are some synergy values. You will often see that related to food. So you'll see food businesses co-located inside of a gas station, convenience store, something like that. Happens frequently, yes. Yep. Other questions? Allison, any questions from online? Okay.
I have one more. You mentioned partnership for that like other 30% versus 70%.
Yes.
What do most agreements sort of look like in terms of long profit shares, equity, or does this kind of depend on partner?
Yeah, I think that there's a pretty broad range of what those agreements look like. I would say that in most instances, the operating partner typically retains the majority of the equity, but puts in a minority of the capital. So they typically are going in for a little bit of money, but not a lot, but they own most of the equity, but not all of it. Because the investor, the investing partner, they have money, they don't have time. And the operating partner has time but no money. And so when you put all that together, it does make for a good partnership. But who owns what and how it's structured is a negotiation that's very unique to that deal. Yeah.
That's kind of contrary to the ETA model where you would be the CEO or operator, but have less of the equity.
Correct.
The investors come in and take 75%.
Correct. I think that the ETA model, I think because the dollars are a lot bigger, the incentive is still there for the owner operator to participate, even if they have a smaller percentage, because the dollars are still large. And the investors, to be completely honest with you, are just greedier because they realize that that operator will do it by owning 15 or 20 or 25%. They'll still do the deal. And so to some extent, they cram down the operator because they can. Not because they should, but because they can.
Is there a franchise, you've been doing this for a while, is there a franchise that you think is just like really great, but does not have a presence in Pittsburgh?
That's a really good question. Until recently, I would have told you that it was Crumble Cookie, but they opened up in the last year, right? Crumble's a really, really, really good brand.
Even though it's food related.
Yeah, because the margins are just silly big.
Yeah.
I mean, I go in there, my daughter goes in there and buys a dozen cookies and it's $44. And I was like, what just happened to me? And then I take 3 bites of the cookie and I'm like, oh, I'm so in heaven right now. Right. I mean, it's just like, it just emotionally just like, it's a riptide on me. So yes, it's food, which I don't normally like to invest in, but that brand it's pretty good. Right. None that I can think of offhand. But you know, I think that's an interesting question because Pittsburgh does tend to be a later adopting market. So it's likely that there are brands that have done well other places that just haven't migrated to Pittsburgh yet. Yes. Other questions?
Would the franchise model work across the country?
So this is a very good question. I think every franchise brand has very clear parameters of what a successful territory looks like today. Okay. So for example, not every market in the country will be able to hold a luxury beauty brand because there are not enough density of high income customers close to the store to support it. But almost every market in the country could support a 7-Eleven. Okay. So I would say to you, the franchisors are typically pretty good about clearly defining, this is our customer, and this is the minimum threshold of customers that we need within this radius. If they don't exist, we're not going to put a store there. Okay? Because they don't want a failure either. So I think that's a very brand specific issue, but I will tell you that every brand has parameters of what they need to succeed and where that can occur. Yes.
Are they relying on like census data for that density, or are they kind of going out and checking neighborhoods?
Yeah, it's a really good question. So I think that the sophistication of that market research at a franchise level is extraordinarily high.
At the franchisor.
Correct.
They're doing.
They are the franchisor. When they launch a brand, they have done extensive research to identify target customers, where they're located, where they work, how many live where, and they create heat mapping to show where successful locations could be located. Yes. They take that on their shoulders so that they then know what they're offering to potential franchisees. Yes. And it's very sophisticated analysis. That piece of it, the franchisors typically do very well.
Well, sorry. So does the franchise model work for franchisor international?
Yes. There's a lot of international brands that come to the US. There are US brands that go international. So yes, I think that assuming that you are creating a brand where there is local demand for the service, internationally it works 100%. Yes. When a US brand launches internationally, they typically do it a bit differently though. They typically look for either a national or a regional partner. So they might say to a large investment group, look, we're going to launch Burger King in Brazil, and we're going to open 200 stores in Brazil. You are going to be the only franchisee. You're going to open all 200 of them. And we're going to give you 10 years to do it. Right? So it's not going to be, I've got Manaus, and you've got Rio, and you've got Sao Paulo. They're not doing it that way. They're doing it a country at a time or a region at a time.
That's crazy.
Yeah. But there's a lot of investment groups that's what they want, right? They want to take off a whole country, or I'll take all of South America, right? Because if it's a large investment firm or a big PE firm, that's the kind of scale that they want. Yeah.
But that partners, they are usually, for example, food carriers.
Yes. So the partner to pull something like that off is typically somebody who already owns related businesses. Yes, absolutely correct. Somebody who has experience and capital and a team to support that kind of thing. They're not new to the table. They're a really known commodity. Absolutely correct. Yes.
Yeah, so from what my understanding was, most of this was how you will deal with all of this from a franchisee's point of view.
Yes.
Franchisor. So if I have a business and I have to figure out what would you say are the identifiers that, well, now I should take a step ahead and accept franchisees or extend.
Great question. So my experience has been that the prerequisites to that are you need to have developed your model. You need to have seen that it works and has become profitable. You need to then duplicate that another time in a completely unique market to test yourself, allow that to mature for my opinion, 2 years, and then we can have a discussion about it. Okay. It's a long road because look, if I'm a franchisee, a prospective franchisee of your business, okay, what are you selling me? What you're selling me is a system of doing business that's been proven to work in multiple locations. Until you can sell that to me, just keep building the business. But as soon as you can sell that to me, now we can have a conversation. Yeah. So I think franchisors typically need to build a business in multiple locations successfully, and then we can have a conversation about how that can be franchised. Does that make sense? Yeah, good. Other questions?
I have one on.
Yeah, go ahead.
Can one set opportunities to acquire franchises from operators who are underperforming, and if so, how so?
Okay, terrific question. So, yes, there are opportunities to buy underperforming existing locations. But here's the but. The but is often, if that's a good opportunity that's failing because it's a bad operator, not a bad business, that location is often going to be scooped up by somebody who's already inside of that brand. So for example, if the McDonald's in Oakland, which I sense is a pretty good location, but if it was bad, ended up being a bad location because it had a bad owner who was just not investing in the business, hiring bad staff members, the McDonald's owners on Penn Avenue would likely step in and say, we're going to buy this location. We're going to replace the management team. We're going to invest in cleaning the place up, and we're going to have the thing growing and thriving again. If you're finding out about it as an outsider, I would be a bit wary, because it typically means that all of the inside folks who have knowledge of the market passed on it for a particular reason. So unless you have knowledge of why they passed on it, go into that with a high degree of skepticism as you look at that particular opportunity. Okay? All right. Other questions? All right. Well, I appreciate everybody joining in today. For those of you online, I'm glad you joined in, and I'm here for any questions. You can just email me anytime. Thank you.